If I had a nickel every time someone asked me whether they should invest in real estate or stocks, I'd have a lot of nickels. The thing is that whenever someone crosses a certain threshold of savings, they are faced with this standard choice. So, in this video, I am going to clear up everything you need to know before making this crucial decision with your money. Make sure to watch till the end, because I'll share an interesting strategy that unlocks some of the benefits of real estate investing without all the hassle. Chapter 1. Overview. Alright, so let's break down these two investment titans. First up, we have real estate. This one's pretty straightforward. You buy a property like a house or apartment, and you can either hold on to it and collect rent from tenants, or you can sell it later for a potential profit. It's kind of like owning a little piece of the pie, and that pie can grow in value over time, on top of the rental income you bring in. There are different ways to play the real estate game, whether you're flipping houses, renting out single-family homes, or even owning a piece of a commercial building. Now, on the other side of the coin, we have stocks. They are essentially tiny ownership shares in companies. When you buy a stock, you're basically saying, hey, I believe in this company and I think it's going to do well. If the company does well, its stock price typically goes up, and that means your investment grows too. Plus, some companies share their profits with shareholders through dividends, which is like a little bonus check for owning a piece of the action. So that's the basic gist. Real estate, you own a piece of property, potentially collect rent, and aim to profit when you sell. Stocks, you own a piece of a company and your investment grows with the company's success. Now, let's explore the key differences between these two. Chapter 2. Key Differences. Alright folks, now that we've gotten comfortable with the fundamentals, let's dissect the key characteristics that make real estate and stocks distinct investment vehicles. The first battleground is liquidity, which essentially refers to how swiftly you can convert your investment back into cash. Imagine this. Selling a house can drag on for weeks, even months, depending on market conditions. There's a whole lot of paperwork, inspections, and negotiations to navigate. Real estate falls under the category of illiquid assets, meaning you can't readily tap into those funds. Stocks, on the other hand, operate on a completely different playing field. They're traded on exchanges every single day. Stocks boast high liquidity, allowing you to buy and sell them with just a few clicks, making your money much more accessible. The next frontier we need to explore is management involvement. Real estate can be quite the hands-on investment. You might find yourself dealing with repairs, routine maintenance, and the never-ending quest to find responsible tenants. It can be a demanding job. Stocks, in contrast, are generally a more passive investment. Once you acquire them, the company itself handles the day-to-day operations, freeing you up from those responsibilities. Another key differentiator is the upfront cost. Stepping onto the real estate ladder often requires a substantial down payment, which can be a significant obstacle for many people. Stocks, however, can be purchased for much smaller amounts, making them a more accessible option for a broader range of investors. Finally, both real estate and stocks provide pathways to diversify your portfolio. In essence, diversification means spreading your investments across various sectors, like not putting all your eggs in one basket. With real estate, diversification can involve owning different property types in distinct locations. Stocks, on the other hand, allow you to invest in companies across diverse industries, mitigating risk by not being overly reliant on the success of a single sector. So, liquidity, management involvement, down payment requirements, and diversification. These are the crucial features that set real estate and stock investments apart. Chapter 3. Returns. Now it's time to talk about the exciting and sometimes nerve-wracking world of returns, what you can potentially gain from your investments. Let's start with real estate. Historically, real estate has offered average annual returns in the range of 4% to 8%. This includes both the rental income you collect and any appreciation in the property value over time. It's important to remember, though, that real estate returns can vary significantly depending on the location, property type, and overall market conditions. There can be periods where property values stagnate or even decline. Now, let's shift gears and look at stocks. The stock market, on average, has delivered higher returns than real estate historically. The S&P 500, a broad index that tracks a significant portion of the US stock market, has shown average annual returns of around 10% over the long term. This includes not only stock price appreciation, but also dividends paid out by companies. Here's the catch. The stock market is known for its volatility. Unlike real estate, which tends to grow at a steadier pace, stocks can experience wild swings in price, both upwards and downwards. This means you can see significant gains in one year, followed by losses in the next. So, when it comes to returns, real estate offers a potentially smoother side with consistent rental income and long-term appreciation, while stocks boast the potential for higher overall returns, but with a bumpier journey. In the next section, we'll tackle the flip side of the coin, the risks associated with each investment. Knowing these risks is crucial for making informed investment decisions. Chapter 4. Risks. No investment is without its fair share of risks, and both real estate and stocks come with their own set of challenges. Let's delve into the potential pitfalls you might encounter with each option. First up, real estate. One of the biggest concerns is vacancy rates. Imagine this. You own a rental property, but you can't find a tenant. That means no rental income to cover your mortgage and other expenses. Vacancy rates can fluctuate depending on the location and overall market conditions. Another risk factor is maintenance costs. Owning property means dealing with repairs, renovations, and unforeseen issues like leaky roofs or malfunctioning appliances. These costs can eat into your profits and require significant upfront investment. And let's not forget about market downturns. Just like any other asset, real estate values can decline. If you need to sell your property during a recession, you might end up taking a loss. Now let's switch gears and explore the risks associated with stocks. The most prominent risk is market volatility. As we mentioned earlier, stock prices can fluctuate dramatically in a short period. This means there's a chance your investment could lose value significantly in a short time frame. Another risk factor to consider is company performance. If the company you've invested in experiences financial difficulties or makes poor decisions, its stock price could plummet. Finally, there's the element of economic factors. A weak economy can have a negative ripple effect on the entire stock market, potentially leading to widespread losses. So, when it comes to risks, real estate presents challenges like vacancies, maintenance costs, and market downturns. Stocks, on the other hand, grapple with market volatility. Chapter 5. REITs. Now, before I move on to concluding this video, let me tell you about that bonus strategy I mentioned earlier for unlocking some of the benefits of real estate without the hassle. Buckle up, because here it comes. For those of you intrigued by the potential of real estate but worried about the high upfront costs, illiquidity, and management headaches, there's an option called Real Estate Investment Trusts, or REITs. Essentially, REITs are companies that own and operate income-producing real estate portfolios. Here's the beauty. You can invest in an REIT just like you would a stock. This allows you to gain exposure to real estate without the burden of directly owning and managing a property, benefit from diversification across different property types like apartments, office buildings, or healthcare facilities, enjoy potential for dividend income just like owning rental properties. REITs offer a more liquid investment compared to traditional real estate. You can easily buy and sell them on the stock market. However, keep in mind that REITs are also subject to market fluctuations, so there's still an element of risk involved. So whether you're a seasoned investor or just starting out, REITs offer a compelling way to tap into the real estate market with greater accessibility and potentially lower barriers to entry. Chapter 6. Conclusion. So to sum it all up, there's no single safest investment. The ideal option depends on your individual goals, risk tolerance, and investment timeline. For those seeking a more hands-on approach with potentially high returns, real estate might be a good fit. But if you value liquidity, diversification, and a potentially smoother ride, stocks could be the way to go. Or you can access real estate benefits without the management headaches through REITs. The key takeaway? Do your research, consider your options, and consult with a financial advisor to develop a personalized investment strategy. If you enjoyed this breakdown, be sure to leave a comment below and let me know which investment option piques your interest the most. Hit that like button, subscribe to the channel for more informative content, and stay tuned for future videos where we delve deeper into the world of finance.